Well, it's now 1 o'clock, so we'll get started here in a moment. I did want to make sure everyone realizes we are offering CPE for this webinar. So during the next 45 minutes or so, you will have a couple of polling questions just to answer. We're required to do that in order to provide the CPE certificates. So don't stray too long, but hopefully it won't be too boring. Obviously, our topic today is around the COVID and impact on all, but we're also going to talk a little bit about SBA program and some implications there. For those that know me or don't know me, I'm Dan St. Clair. I'm an audit director at Briggs. Work very closely with the banking team and the firm's quality control. Also online, we have Eric Deal. He's an associate director with B&V Capital Advisors and been a key member of our SBA task force that's been working on this for really about a month now. And then behind the scenes, we have Lincoln McKinnon, also on the SBA task force and part of the banking team at Briggs & Veselka. He'll be answering questions as they come along. And on that note, I'm going to let Eric Deal get started on some of the SBA comments first, and then we'll flip back to the allowance here in a few moments. Eric, are you there?
Yeah, thanks, Dan. Appreciate everyone joining us today. I know I probably get no less than 2 or 3 webinar invitations on a daily basis now in the COVID-19 era, so we certainly appreciate you or everyone dialing into for our presentation today. But for those of you who don't know me, my name is Eric Deal. I'm, like Dan said, part of the B&V Capital Advisors group here with Briggs, which is the investment banking subsidiary of the firm. Our group focuses mostly on buy-side and sell-side M&A with several capital raise engagements as well, both on the debt and the equity side and anything in between. I've been with the firm for about 2 years. Now, actually, Thursday's my 2-year mark. And prior to B&V, I was a commercial lender here for a regional bank in Houston, as well as a small community bank before that. So everything that's been going on with the CARES Act and the SBA has been particularly interesting for me, and perhaps preferable to follow from the outside, as I know many of you lenders on this call are absolutely inundated with the SBA volume surge and the reporting issues that Dan will talk about today, and which are continuing to evolve on a daily basis. And all that's while trying to maintain safe operations for employees and customers. So can certainly to relate what banks and lending institutions are going through during this time. So as many of you are lenders, those of you listening are on the front lines of the PPP and probably know more about how this is working or perhaps even not working than we do. But we thought it would be helpful for us to share at least a little bit of feedback that we're getting from our clients and some of the conversations that we're continuing to have surrounding the PPP as well as other government programs as well. Safe to say the volume for applications of the PPP is nothing short of astronomical. The last figures I saw were over 1 million applications had been approved, and that's coming from about at least 4,600 different lenders. And that was at the 250 billion mark of the PPP. And so it's increased since then. But average loan size from what I've seen is about 240,000 for the PPP. And for a little bit of perspective, in 2019, based on what we saw, the SBA handled less than 60,000 applications and funded about 25 billion in loans. So what's going on is it's absolutely crazy, quite honestly. Now, granted, that's comparing kind of a 4-page PPP application with the much lengthier traditional SBA loan application, but just kind of goes to show, based on how unprepared everyone was for this, the SBA included, it's pretty amazing what's been going on. So in the beginning with our clients, most were scrambling to complete applications, just as banks were scrambling to get them processed. We held a couple of webinars initially to walk through our interpretation of the CARES Act and what it comes down to, which is ultimately the payroll costs. There's still a lot of aspects of this that aren't clear, but nevertheless, last week we pivoted from kind of the application part of this to providing more of our interpretations on maximizing loan forgiveness, which is kind of the second wave or the second part to all this. And I keep using the word interpretation because, as you know, banks, CPA firms, industry groups, really all of us kind of collectively agree that there needs to be more guidance provided by the SBA, which we hope is coming. Very briefly, for programs outside the PPP, we've been speaking with clients about ALLL grants, which is largely seem to be MIA. This is where customer or borrowers can go out and apply for up to $10,000 emergency funding through the disaster loan program. We've talked to many clients who have applied for it, received some sort of confirmation number or reference number, but then haven't received anything. Actually, I just heard from one client today who finally received it after they applied. I think it was at least 2 weeks ago, if not more. So certainly the SBA is working through these. The funds do not seem to be coming or being funded as quickly as everyone would like, but they do seem to be coming slowly but surely. We've talked to our clients about the Families First Coronavirus Response Act. Actually, our head of human resources at Briggs did a webinar last week discussing the details of family and medical leave and other employee-related issues. So if that's of interest, that should be posted on our website, as are all of our other webinars. Lastly, the Main Street Lending Program, it's still in its earlier stages of being developed. And again, I imagine most of you listening are staying on top of this and awaiting more details like we are, which are hopefully coming soon. But Briggs is holding another webinar this Friday to cover the fundamentals of that program, if that's of interest to anyone. So the big question now is, with the second round of PPP funding, or with the first round of funding gone, essentially, when is the second round coming? Looks like it could be this week. The Senate is set to convene at 3 o'clock today, Central Time. And it's possible that the House could vote as early as tomorrow on increasing the funding. But for now, we're just not sure how much of the $250 billion that's being proposed would be available for the PPP. And I've also heard of industry groups. I think ICBA is one of them, who's advocating that a portion of this next round of funding be carved out for community banks. So we'll see what happens, and we'll see, as that rolls through, what winds up happening. So as we go to the next slide, we'll touch a little bit more on forgiveness. And so this is what we've been talking to our clients about now that the first wave of PPP applications have been approved and companies are starting to get funded. We're looking ahead towards the forgiveness process. And what we're reiterating to our clients is that forgiveness is not automatic and it's not guaranteed. I almost think of it as almost as a reverse underwriting, where the bulk of the paperwork and the analysis actually comes up at the true-up period after the funds have already been distributed. So, we're guiding our clients to use the PPP for qualified expenses so that they'll be eligible for full forgiveness, but keeping in mind, even if they don't qualify for 100% forgiveness, that's not necessarily a bad thing, with any outstanding balance being amortized over 2 years at 1%. Should be pretty reasonable given the interest rate there. But we don't know too much about the forgiveness process yet, and we're hoping the SBA and Treasury Department will put forth additional guidance soon. But on the next slide, we'll kind of go into a little bit more of this in detail. Our role as a CPA firm is helping clients keep deliberate, accurate records of all information in order to help them eventually maximize their loan forgiveness. So I wish it were easy, as this chart illustrates, but in reality, it requires borrowers to be very meticulous in the record keeping. One way to track this is to open a separate bank account dedicated to PPP funds flow only. This makes it very clear on what the PPP proceeds were used for, and it also avoids commingling of funds once those loans are distributed. Borrowers need to understand their daily payroll costs and have this data available, presumably for lenders and the SBA when it comes time to apply for forgiveness. So this documentation includes a lot of different things, but including supporting data, for number of employees on the payroll, for pay rates and pay changes during this time, IRS payroll tax filings, state income local tax, as well as unemployment insurance filings as well. So we're basically just telling clients, save everything. You may or may not need it at some point, but anything that goes on during this 8-week period after you receive your loan, keep track of it because it ultimately may be needed to support forgiveness. For expense management, one of the major qualifiers of forgiveness is using at least 75% of the proceeds for payroll costs and no more than 25% for other qualified costs, including rent, utilities, and certain interest expenses. So we're helping our clients kind of begin with the end in mind there and think about these things and planning ahead for forgiveness, which again is not automatic. So what's next? Looking at the next slide, we've talked about the latest updates we've seen on round 2. Hopefully that's coming this week. The other side of this is that while PPP is currently out of funds, there are thousands of companies out there who have already been approved but have not yet received their funds. And as these are trickling in, I think this goes back to the surge in applications that the SBA is going through, and banks as well, quite honestly. But this is becoming more of an issue with companies that are still waiting on funds. So we've heard a lot of feedback from clients that have been approved but are still waiting on those funds to ultimately come. Secondly, and I touched on this a little bit, the additional guidance is still needed. There is still additional guidance needed on a number of aspects. I've left out several from this list, but at a high level, we're looking for guidance on the forgiveness process itself. As we understand it, it would be processed through the banks and through the SBA. But what specific information, what is the minimum level of information that clients need to have ready? There are 2 forgiveness adjustments that will go into this as well. One is for the FTE reduction that may occur during the 8 weeks after the loan is funded, and the other is a reduction in employee salaries. We're still waiting on guidance on both of these. We went into a little bit more details of these in our last webinar on Friday, which again is on our website if that's of interest. But we weren't quite sure how to precisely calculate these adjustments without making very large assumptions. So we're hoping to get additional guidance on this. Lastly, and I mentioned this earlier on the Main Street Lending Program, it's a newer program seemingly designed for larger companies. The minimum loan size as it stands now is $1 million, but there's been industry groups lobbying to actually get this reduced to closer to 50,000 or 100,000 to make sure smaller companies can apply for this as well. Companies with up to 10,000 employees and 2.5 billion revenue can apply for this. And one interesting element that might be of interest to the bank specifically is that lenders are slated to retain a 5% interest in these loans after the Fed purchases 95%, which would probably prompt additional accounting treatment and consequences, giving Dan the opportunity to put together another webinar, probably based on the Main Street Lending Program. But for now, I'll turn it over to Dan. And again, he's our headline speaker talking about the consequences of ALLL. So certainly happy to answer any questions. And again, appreciate you guys taking the time. And last thing I'll say is we do have our BVCA website. I meant to put the link in here, but we have a dedicated page for COVID-19 that has all our webinars, and I'm sure we'll put this one up there as well.
Eric, thank you so much. Appreciate you going through some of the highlights of the SBA program. It's been an ongoing and very moving topic for a while. And as Eric pointed out, I mean, we're still looking for the forgiveness piece and a little more information on that. I have heard speculation of the SBA purchasing up most or all, like Eric just alluded to, purchasing 95% of the loan. So we're still kind of waiting to see exactly what's going to happen there. For the remainder of this webinar, we're going to kind of switch gears and look at the allowance and kind of what's going on with adjustments and modifications due to COVID. Luckily, the interagency group came out with guidance for everyone related to modifications and what's happening due to COVID and how that's impacting customers. I've quoted OCC Bulletin 2020-21, probably the easiest to find on the OCC website. But basically what the regulatory agencies have said is that, you know, we need to come out and be proactive in meeting our borrowers' needs. Just to quote right from the interagency news release, the agencies view prudent loan modification programs offered to financial institution customers affected by COVID-19 as positive and proactive actions that can manage or mitigate adverse impacts on borrowers and lead to improved loan performance and reduced credit risk. So really the goal here is to not necessarily wait on customers for the help needed, but to be aware of your customers and to be forward-looking and proactive in trying to provide that help. So really the underlying theme of this is that, you know, like I said, being proactive is in the best interest of both the bank and the borrowers and the economy. So really, what does that proactive approach look like? Now, we're going to touch a little bit on some of that forward-looking stuff, and I don't want banks to get you know, too muddled down with CECL versus non-CECL and what that implication is. Those of you that have read my white papers in the past on CECL know I firmly believe that what banks do today matches CECL better than the old guidance, and I don't really want to get into that too much today, but my point here is that what you're doing with your allowance methodology needs to continue, and it needs to be active and changing based on what you're seeing in your customers and in your local economy. So what does proactive really look like? The guidance came out and talked about various types of loan modifications, and these may include a deferral of payments, waiving of modification fees, and assistance with government-backed plans. So deferral of payments can be added onto the end. It can be allocated over the life. There's so many ways that loan modifications could happen. And really the key that I want to make sure everyone's hearing is how important documentation is going to be during this time. I mean, Eric really pushed on the documentation issues related to SBA and the PPP program, which is absolutely true and vital. And I think it's equally true in your allowance methodology and how you're dealing with these. So according to the guidance, short-term modifications had an example period of 6 months. Now, is that to say everything can be 6 months or can't be more than 6 months? I think we have to read into this, you know, kind of with a grain of salt, but the example period is 6 months. And so I think that gives us a little bit of guidance to be able to take a step back and look at the customers and what their needs are. And if we have a deferral of payments or say an extension to the end of the loan, clearly if it doesn't exceed 6 months, the guidance kind of gives us that okay to utilize that time frame. Now it does go on and talk about other delays that are considered insignificant. Quite frankly, I think with a lot of loans, a 6-month period doing a step back might be considered significant in the face of the loan. However, I also think if you're looking at big picture and the impact of COVID-19, we all agree after a full month of sitting around in more isolation, you know, 6 months isn't that significant compared to our economy. And, you know, we watch the news nightly and wondering when we will open back up, you know, and I hear speculations that, you know, we won't see another sporting event until 2021. So hopefully this will change quicker. There may be more guidance if this continues even longer, that 6 months is extended. But, you know, let's start with that 6-month period. Now, Another piece of this is that loan modifications on existing loans would not be considered troubled debt restructurings. And this can be either individually on a specific loan or part of a modification program for creditworthy borrowers. So one of my comments to lenders right now is to look at your portfolio of loans. One of the real keys is knowing your borrowers, knowing the impact of the economy, and this has always been true, but it's kind of hyper now in the environment of COVID of who really is being impacted. So we want to work with those customers that are going to be most effective. And the agencies also said they will not criticize institutions that work with borrowers as part of a risk mitigation strategy that's intended to improve an existing non-pass loan. So you may have a loan that's already not on the pass that you're working to improve, and modifications will not automatically trigger a downgrade in rating. Now, we all know that we've got to look at each loan just like we always have been to know where the risks are. And that is one of the purposes of the discussion today is taking those at-risk loans and looking at what we can do to help stem the tide of risk for both the bank and the customer to make sure we get to the other end where this can be an ongoing customer that fully pays back their loan, which is what everyone wants from the very beginning. Now, I found it interesting that it talked about modifications can be to both independent individual loans or as part of a group. So one thing that has come up in discussions, especially if you have a portfolio, say of hotels, a higher risk group, it would probably behoove you to put together a program for all of your customers in that particular line or I'm going to go to the common risk characteristics, but that industry, that hotel group, and have a program that allows your borrowers to opt into a program to, let's say, defer loan payments for a 4-month or 6-month period to help stem the tide while, obviously travel's down and the use of the hotels are at an extreme low. Not every borrower has to take advantage of that modification, but to be able to proactively say, we're offering this type of modification to all of our customers in this industry or in this vein of lending, shows both the proactiveness of the bank, that you're aware of the situation, you're aware of the risks they're going through. Even today I was reading, online, talking about, people wanting to defer rent, and that landlords, of course, still have to pay their mortgages to the banks. And so as individual renters are trying to defer rent to the lender, to their landlord, that person has a mortgage on top of it that they owe to the lender. And so knowing that the push back is going all the way down to the individual level, whether that's in multifamily or strip malls with restaurants, et cetera, a lot of those smaller entities are not able to pay their rent and asking for deferrals from their landlord, and therefore being able to provide a similar type, and I don't want to use the word forgiveness because we're not forgiving the debt, we're just deferring the payment. And it's very clear from the interagency guidance, we're not asking banks to stop the interest income over the time. We're asking them to defer payments. The nice thing also, and I think there's a slide in a second, is that deferring of a payment doesn't mean that there's a past due issue or a non-accrual issue. If we, through a program, offer a deferral, that's actually part of the contract now, because we've actually offered a contractual agreement to move those payments further down. So as long as we're within the contractual rights of the individual facility, there's not a past due issue. So we can offer some of those programs to our customers to delay payment on the loan, to give them time to deal with their own customers who are also delaying those payments. Another thing to note is if there are state or federal government mandates, whether it be loan forgiveness or being able to defer payments on certain types of lending, any of those type of things that are mandated by a government agency are also outside the scope of troubled debt restructurings. So as we just talked about, any kind of deferral would not trigger past due reporting because it is part of the contractual payments as designed. So what are some next steps? To me, like we talked about, you've got to know your portfolio. You've got to know your customers and the industries that are most likely to be impacted, and to be proactive in working with them to help them through this time of need. One thing I'm very proud of working with community banks across the state, even as we started into this pandemic and early on in the stages before there were stay-at-home requirements, what I was hearing from bank presidents and from chairmen of the board was, what do we do for our local community? What can we do for our people, both internally as far as your employees, but also for your community? And how can we stay open and serve our communities during this time of need? Banks are, I won't say isolated from the pandemic, because no one's isolated from this mess. And we're more at risk of loans going bad than we've ever been. But we also have some of the stability in our communities of having been through the good time and the bad, and having a little more resources behind to make sure that we and our customers and our community can make it through this time as unscathed as possible. So I would say consider modification programs for groups of loans, whether it's residential loans or hospitality loans, anything that, especially where you know that the loan is dependent on someone else paying their money in first. There's so many people talking about, rent strikes and deferring of rent. And I don't think most communities in Texas have been overly impacted by it, but they're out there. And should this go on much longer, more and more of our customers are going to be impacted by those issues. So it's really better to get out there in front of this versus waiting for it to actually impact us. And so while we're looking forward, let's make sure we're documenting. If you put together a modification program, find a way to identify those loans separately so that we can modify them. One of the suggestions I've heard talked about is being able to lower interest rates for a short period of time, just to give a little more breathing room for the customers. Well, remember, if you lower an interest rate in the system, that's not automatically going to change back in the system once the modification period's over. So you really need to be able to track and monitor any of those activities so that we can figure out how to put them back at the original loan parameters once that modification period's over, if it's something that goes back. Obviously, a deferral or adding on additional would automatically go into that. And as we already talked about, the regulators are not planning to come in and automatically downgrade credits where there's good faith effort to help your customers get through this COVID period. They do realize that it's best for the bank and the customer, and most importantly for the economy as a whole, if we can help everyone through this time. So like I said, find a way to track those modifications to keep an eye on them. This is especially true of any short-term concessions so that we can return to that pre-COVID terms as needed. The next thing I want to talk about is don't be reluctant to utilize your pass watch or special mention categories to track those high-risk loans. One thing that Eric was talking about, the PPP loans, and if you've got many of those on your books, do realize these are not risk-free loans. And yes, they're supposed to be forgivable and fully forgivable, but there's still the due diligence side of the underwriting that's not going to be really looked at until later. So I've been asked, do we even need to put a PPP loan on our methodology, on our allowance calculation? And I truly believe they need to be there, if nothing more for being able to track them separately from the rest of the portfolio. And that may be that we're talking about, 10 basis points or 20 basis points. I don't know that you need a full, 1.25 allowance on a PPP loan because it is a reduced risk loan. And we all agree with that. In finishing this year's audit period, I noted that most community banks have a small cushion in their allowance calculation already. And being able to put 10 or 20 basis points on your PPP loans probably is not going to eat into that full amount of a cushion. We're talking about $30 million of loans needing at 10 basis points, $30,000, and most allowances had that level of cushion in the unallocated. So I do think it's very important for you to be able to put those in as a separate type of loan for monitoring and for proactive working with those, because there may be downgrades within those, and we're going to have to continue to watch for those. But outside the PPP loans, you've got credits on the books for a long time. They're impacted by COVID. They're in a high-risk industry. They've been past all their life, but now they're struggling and we know it. And that's what I'm saying. Don't be reluctant to go ahead and put them in a pass watch category, identifying them as COVID-related loans so that you can track them. That way you can keep an eye on potential further downgrades as those are needed. Because the last thing you want to do is come out in 6 months trying to reverse some of the COVID impacts and find that a loan has actually gone worse than you would have wanted. The borrower has had more struggles than you would have expected, and then it being highly impactful on your allowance methodology 6 months from now, instead of a gradual movement of that over time as we watch and work with those clients. Very clearly, don't wait on adjusting those qualitative factors, just waiting on the quantitative factors to catch up. One of the real nice things about the allowance, and I think it's on the next slide, it's a living document. And as the quantitative factors are known, those qualitative factors can be adjusted up or down. I really do look at most of the qualitative factors as being the risk of the unknown. What's out there that could potentially happen that's not part of our loss history, the quantitative piece. And as we watch potential risk go up from a quantitative point, we can adjust those qualitative factors in an opposite direction if it's offset, or slightly less if our total allowance needs to go up. But we don't have to just accept a higher qualitative factor if and when quantitative factors go up. They can be used to offset and work together for the good of the full allowance as a total methodology. And that's how it's meant to be anyway. So just to repeat, be proactive. You need to be watching those those relationships on an ongoing basis. Good management now can really help limit the negative impact down the line. So being able to watch what's going on with your customers is what we're wanting from an allowance always. I really do think that this is kind of the meat of what CECL wanted to add overall. And like I said, this really isn't about CECL, but CECL kind of is what you're doing already, just in a little bit broader sense. So be proactive, look for those qualitative adjustments that need to be up now due to the risk. Make sure that that allowance is a living document. I know usually we adjust these on a quarterly basis in them. Not saying make major adjustments more often than quarterly, but I think right now is when we need to be discussing these more often, because we might need some monthly adjustments for certain industries, for certain loan groups that would not have happened in a normal circumstance. And we are working in unprecedented times right now. And so we're just about to the end. I'm going to open it up to see if there's any questions. And I saw that we have one or two answered. I do want to repeat, how proud I am to work with the community banking industry. I think our groups have been proactive all along in helping. And I think we tend to put our community and our people first, as always. And so that's the impact we'd like to continue to have, throughout this great state of Texas as we work to get us all back to our normal lives. Any questions or concerns? I did note that one question that got answered, and I think this was put online, was talking about as a small bank that's struggling to meet the needs of the local businessmen and women. Are they required to complete PPP loan requests for applicants outside of their assessed area that are non-customers of the bank? Well, my honest answer would be, obviously you want to take care of your bank customers first in your local area first. But if you have the capacity, why wouldn't you want to help in the situation? I do believe that there's some decent fees that are coming out of this. One of the big questions that we've received from several banks over this time is fees coming in from the PPP program and whether those have to be deferred over the life of the loan, or can they be booked up front? And I don't see any reason why PPP fees would be treated any differently than typical loan fees. So our guidance has been that this should be deferred over the life of the loan. Now, many banks already are not deferring the fees. And when I talk about fees, I am talking about net fees. We do know that origination costs can be offset with the fees so that you're really deferring the net fee or net cost over the life of the loan. So when I'm talking about deferring the fees, I am talking about net here. But being able to track any PPP fees that you receive separately, I think could go a long way, especially if you're booking them up front, to be able to have that audit trail to show the auditor that truly the total fees received over the life of the PPP program were immaterial to the overall financial statements taken as a whole. So I've heard different comments from different banks, whether they're going to take 100% up front or whether they're deferring it over the life of the loan. True audit gap would be that we're deferring over the life of the loan. Now, if we sell the loan or once it's forgiven, the other question that's come out is, at that point, can we take 100% of the fee? And that is absolutely. If the loan is forgiven before the 2-year program ends, as soon as that loan is forgiven, any remaining fee that's still not been amortized into your books would be considered income at that time. And I think I haven't seen any other questions. I'm going to kick it back. Eric, do you have any other comments out there while we're still here?
No, I don't think so. I think I kind of glossed over my initial comments kind of on these two forgiveness adjustments. So in kind of going back, maybe just circling back a little bit there, but there's basically two, and again, we're needing more kind of commentary on this. But I mean, really and this kind of goes back to the whole spirit of the PPP, but which is really to keep employees not only keep staff not only employed, but also keep them at their current or at least close to current wage levels. So the two forgiveness adjustments I think could be fairly significant for borrowers. And so, the first one again is going back and looking at through that 8-week program or the 8-week period after a loan is funded. Borrowers have to maintain their head count, and it could be based on a couple of different averages, but mostly that either 2019 calendar year or kind of a trailing 12-month period looking back. So, that's where we're seeing a lot of our questions come through from clients, is on these adjustments, and unfortunately, we're just, still seeking some guidance from the SBA on that. Some of the other questions that we've been getting to are just on, calculating payroll costs, because what you have to remember is calculating the payroll costs on the front end to actually determine the loan amount comes back into play on the forgiveness side as well. So how borrowers are calculating those costs up front matters for the forgiveness as well. And so we're getting a lot of detailed questions on that as well, especially as it comes to benefits and how those are tracked. One question we get a lot on is on the on the payroll costs as it pertains to employees with in excess of 100,000 in annual compensation. The answer to that, or at least our interpretation of it, is that that only applies to cash compensation. So if you have an employee who earns, 110,000 a year, you'd be able to, on an annualized basis, you'd be able to count the first 100,000 of that and exclude the 10,000. But you do not have to exclude health benefits, retirement benefits, and that sort of thing. It only comes down to the cash component of that. So that's some guidance that was pushed out here recently. The other part of this too, and I was looking on the AICPA website as well, and that's another resource that we rely on fairly heavily as well, is the AICPA. They have a very long list of FAQs that I personally find very, very helpful, and I think there is actually a section for lenders on there as well. And so for those seeking some quality information, I would direct you to that website as well. But one of the things that we're not 100% sure on is, in looking at that 8 weeks and the costs that are forgiven with this, is it on a cash basis or accrual basis? It doesn't specifically say, and the AICPA has said officially that more guidance is needed on that, because that could go into determining the ultimate forgiveness amount as well. Because a lot of companies are asking us if they can prepay payroll costs, prepay health insurance plans, in order to use those funds for qualified expenses and ultimately get them forgiven. And so I think that cash versus accrual is important to get more guidance on as well, because as you accelerate those costs, would those really count if it really is supposed to be on an accrual basis? It can get very tricky there. And so that's something that we're, again, hoping to get more guidance on as well. So those are, a little bit more of the detailed questions that we've been getting, at least as it pertains to the PPP. And obviously, as Dan mentioned earlier, I mean, everything trickles down So it's trickling down, from the payroll costs, payroll providers, to banks and their balance sheets, back to lenders, back to the government. So I mean, it's quite a rat's nest, quite honestly. But again, any way we can be a resource for you, we're certainly happy to help. And if there's any particular elements on the PPP that anyone on this call might have additional questions on, we're certainly share what resources we have. And we're also very interested to learn more about this Main Street lending program. Again, it's in its infancy stages, but it seems to be that could really open up the spigot a little bit, especially for those companies that are backed by private equity. In the investment banking world, that's where a lot of our conversations have been around. Companies that are sponsored by private equity groups or family offices are not qualified for the SBA based on the SBA affiliation rules. At least most of those sponsored companies are not. With the Main Street lending program, those private equity groups or private equity sponsored companies should be eligible to borrow money from there. So that may affect some of your clients as well. For those that are work closely with private equity groups and other types of institutional capital. And as Dan mentioned too, on the restructurings, from a market standpoint, while we're hoping that some of these regulations are eased and the TDR isn't tripped as it normally would be, we're still anticipating a lot of restructuring activity coming up in the next 6 to 12 months, if not longer, unfortunately. And so whether that's bringing in equity to kind of right size the balance sheet from an equity perspective, as companies, unfortunately suffer through this crisis, that's something that we're anticipating seeing a lot of activity as well. So we'll kind of see what happens there. But I think that's probably it from my standpoint, Dan, unless there's anything
Perfect.
else that would be.
No, I appreciate that. And there was one other question I wanted to make sure we addressed. Talking about that, the government guaranteed portion of SBA loans are usually excluded from an analysis on the ALLL because that would be 100% guaranteed. That's one reason I was, actually saying a very de minimis level of basis points, I think would be prudent because they aren't risk-free. We talked to the question actually said, should they be risk rated almost as a cash or CD secured loan because it should be forgivable? And I would say yes. I mean, I think you could do it to that level. Part of what I want to do is make sure that we have them in a bucket that we can track and watch them and monitor them. I would say that there is a little more risk than your typical SBA approved loan. That guaranteed portion, because the underwriting was done early, doesn't have that hidden risk of potential underwriting issues. I would not make it a major new element of any allowance out there. And it's certainly an area of the allowance I would expect to go away in 6 months or a year once these are being forgiven, depending on how this program plays out. As I said, I've heard speculation that once we know more about what's going on, once we've passed giving out these loans, that the government may potentially come in and buy 100% of these loans for the forgiveness sake and let them deal with it versus banks of the ending forgiveness. How that's all going to work out, we're still waiting to see. But tracking it on your allowance with a de minimis amount certainly is not a bad idea. And on that note, I'm going to say thank you, everyone, for joining us today. I hope you found it somewhat beneficial. Personally, I miss getting to talk with so many of you and see you on a personal face-to-face basis. So looking forward to having lunch with many of you after this is over. I know I speak for Eric and Lincoln as well. If there's anything we can do to assist or questions, please feel free to reach out to us anytime. That's part of why we do this job, is we like being able to help our clients. So on that note, have a great day and thank you for joining us.